to Audit Approach, and the units we'll be looking at is Audit Strategies. Unit 2 will be looking at the Business Risk Approach. We'll be looking at System-Based Risk Approach, System-Based Approach, and also the SFP Approach. And those are the 4 units we'll be looking at briefly in this chapter or this module, and we'll end up with our quiz. So let's begin with audit strategies. What are audit strategies? They are overall approach or approaches for an audit leading to the audit plan. So the approach speaks to how you want to carry out your audit. It's the overall direction for the audit, and it forms the basis of the detailed audit plan. Your strategy depends on the scope, the timing, and the approach the auditor will adopt based on the nature of the client's business, his risk profile. After studying it, then also the internal control environment. So that's generally what the definition of an audit approach speaks to. So the strategies include business risk approach, and the focus is on risk, high risks affecting the business, and also the impact of those risks on the financial statements that are produced from the company. This is very important. So the business risk focuses and evaluates or identifies key business risks that may impact the financial statement. And the objective of this is to understand the entity's environment and the strategic risks. What do we mean by strategic risks? Regulatory changes in the environment, competition, technological or technology disruption that could lead to material misstatement. So that's the objective of assessing or evaluating the business risk of the business. And how do we apply this? Often this is used in complex or high risk industry. So for example, a fintech company like MoneyPoint, OPay, one of these PalmPay, all these coming up fintech companies facing regulatory pressure may have revenue recognition risks due to evolving business models. So the business risk approach looks at this holistically and helps address it on a high risk level. So this is very important. And that's a general overview or the definition of an approach or the strategies in terms of business risk model. And also looking at the example I just spoke to a fintech company, there are other industries that could also be affected by this business risk approach, especially high risk industries. So the business risk approach helps us to address risk in these sectors or in these industries very holistically. So there's also the system-based approach, which is different from business risk approach. This approach focuses on testing internal controls. We test internal controls, and these are the controls, the systems, procedures, policies that are designed to run the organization seamlessly. And they include, among others, system-based approach, substantive testing approach, which focuses on testing transactions, postings, and balances. So you are testing transactions to see if they truly match, and also the balances of those transactions per time, per accounting period, to ensure their accuracy. And also the testing focuses on the design and operational effectiveness of internal controls. Some controls are there designed, but they don't work. They are not effective. So you also test their design and also their operational effectiveness. It is one thing to have internal controls, and it's another thing for people to follow those controls. Are they effective? So auditors test those controls to ensure that the objective is to see if you can rely or place trust on those controls, and you are reducing the need for extensive, substantial testing. And that's the objective of the system-based approach. And the application is ideally where clients have strong and well-documented internal controls. It shows that we test the documents and we also see the effectiveness in practice. So for example, a manufacturing company like Coca-Cola, with automated inventory controls for their inventory, their drinks, before sending it out for sales, we may test for system reliability instead of manually testing every inventory movement between opening stock, work in progress, before it becomes the final product. And so we may test those controls to see if the system is reliable than doing manual testing. And that's what the system-based approach speaks to. So generally, we try to test to see the design and substantively ensuring that these transactions and the balances tally and they work or they are correct based on what is being posted. So having looked at system-based approach, we look at another approach, or the third approach, which is the statement of financial position approach. This approach focuses on testing balances for small entities, small companies. So the system-based and the business risk approach looks at high, medium, and high risk industries. But for this statement of financial position, it substantially looks at testing balances for small entities, small companies, and it helps us to validate or place emphasis on year-end balances rather than transactions during the year. So the objective is to ensure that income statement items are less significant or very, very immaterial when we are auditing these small entities. And also is practical for small businesses or where risk is concentrated in assets and liability. So for example, a small retail business like a diagnostic center with stable income may be audited mainly through their cash, their receivables, and inventory balances. So you can see we're looking at their current assets basically to test to see that these are actually correct based on what they posted on their financial statements. So generally, the statement of financial position approach in our audit strategies focuses on testing balances for small entities. And also a combination of these strategies in doing your audit can also be used. There's no hard and fast rule. So the choice factors depends on the business's size. How large is it? Is it small? Is it medium size? Is it large size? And also the control environment, and also what the audit firm prefers based on their risk assessment. It's very important. So there's no hard and fast rule. You could decide whatever approach you want to use, either the business risk approach, the system-based approach, or the statement of financial position approach to do your audit or to form your strategy. So these generally are strategies we use when we are performing audits. So in practice, auditors often combine multiple strategies actually. So for example, you use a system-based approach maybe to audit payroll, while substantive testing may be used to apply or test year-end balances. So the factors including or influencing your strategy choice is the nature of the business, like I said. So larger complex organizations may require risk-based strategy. Also, factors like control environment, like I said, the strong controls may justify system-based approach. Weak controls require substantive approach. The audit firm and methodology or the tools used is also a factor. The audit firm method and their tools. So some firms favor certain strategies depending on their audit software or the resources they have or specialization, their expertise in that area. And also factors like prior audit experience. So previous knowledge of a client can also shape a current year strategy. What they've done last year could shape their current year strategy. So these are factors that could influence the strategy or an audit firm uses. Okay, so that's a brief on the audit strategies. Do we have any question? Let's look at Unit 2. I told you we'll be running so that we can round up before the short time we have. Do we have any question on the audit strategy or any observation?
Okay.
Welcome, Rufiat.
Okay.
Okay, thank you, Julie, for that. Welcome, Rufiat. I could see Rufiat on the call. Welcome, nice to have you.
Good evening.
Hi, good evening, sir. Good evening, Juliana.
How are you doing?
I'm fine.
How are you doing? You're welcome.
Fine. Thank you. How was
You're
your day?
welcome.
Is he what would I
Thank
say?
you.
Is he happy? Is he happy syllabus review or what?
Well, we passed the level anyway, so there's nothing new for us. It's skills people like you sorry for.
Yeah. Seriously, yeah.
Yeah.
Okay, it's nice to have you. So let's run through business risk approach briefly, and let's look at what that speaks to in our audit approach. Okay, so the development of the business risk approach, we are looking at the responses to business complexities. The business complexities differ among our clients and the business we are auditing. So the objective is to aim for efficiency in performing the audit and also producing our opinion based on our audit evidence. So shifting from substantive to systems, then to risk-based, and now business risk are different approaches and also areas we could metamorphose or transit in during the audit work. So from substantive testing to system-based testing and also risk-based audit approach and also evaluating business risks are all areas based on the auditor's assessment. So let's look at business risks. It looks at the threat to an entity achieving its objective. That's generally what business risks speak to. So, okay, somebody wants to interject?
No.
Oh, okay. I heard something in the background. Okay, so looking at the business risk approach emerges as audits needed to keep up with increasing business complexities, like we said. So there's a shift in audit focus over time from substantive testing, like I said, to system-based testing, to risk-based auditing, and to business risk approach. And the aim, like I said, is to increase efficiency by focusing on risks that threaten an ability or an entity or a company's ability to meet its objectives. So the aim should be the focus and how this risk could lead to material misstatements in the financial statement. So this is very important to take note of. So business risks are threats to an entity achieving their objective. So what does it mean? It means to evaluate risks to the business and their impact on the financial statements. So the risk that the business is bedeviled with, and also any risk that has crystallized, that has affected the outcome on the financial statements, auditors need to understand the client's business. This is very important. So the nature is a top-down approach. The business drives the financial statements. Whatever the business does by transactions, it drives what it produces as financial statements. So high level needs good client information. Top down means you're looking at from transactions down to the production of the financial statements. And those risks that affect the financial statements are key. So business risk, generally, some questions come asking you, what is business risk? They generally refer to threats or uncertainties that could prevent an entity from achieving its strategic one, its financial, strategic one, operational two, and financial objectives. So let me take that again. Business risks refer to the threats or uncertainties that could prevent an entity from achieving its strategic, number one, its operational, and its financial objectives. And these risks arise both from internal and external factors, and they often precede financial statement risk. So if they crystallize, they could affect the financial statements positively or negatively. So as auditors, we need to evaluate business risks and also determine their potential impact on the financial statements. A deep understanding of the client's business, the industry where he's domiciled, and his environment, internal and external, is very crucial. And the approach I spoke down, top down, starting from business strategy and operations down to the financial statements preparation level and assertions, are key features of these evaluations. Very important. So high level needs to, we're talking about the client information, we need to be conversant with. Often we use industry specialization and we consider future developments. So internal and external. Okay, yes, please, Julie, let's hear your thoughts. Please go ahead.
Can you go back to the top down again? I think you're a bit fast, if you don't mind.
Okay. Sorry, let me go back through the top down again. So talking about Okay. So I was saying that the nature is top down. Now, top down means the start of the business strategy speaks to the formulation of strategy. What do we want to do during the budget preparation, speculations? Then when the budget is prepared, it now moves to operations, how you carry out your activities, day-to-day sales activities, cost, and all that. So the top, we speak to the strategy, business strategy, the planning, and the budgeting. All those activities that entails the business strategy is the top. Then come to the middle, the operations. Then down, after operations have been actualized, the budget have become actuals. We now look at the financial statement preparation. From top, we're speaking to business strategy formulation. Middle, operations, day-to-day transaction, buying and selling, the marketing and all that. Then down speaks to financial statements preparation, production, and the communication of those documents to auditors for audit. So that's what the top-down approach speaks to. I hope you're a bit clear with that.
Yes, sir. Thank you. Yes, sir.
Fantastic. Please do well to interject and stop if I'm too fast. Thank you for that, Julie. Okay, so speaking to the internal and external risks that may bedevil a company, we're looking at examples provided like loss of a major contract, a new competitor in the market, ineffective employees, or poor financial management. So these are risks you could assess during your audit work. So the loss of a major contract that brings major part of the company's revenue would impact the financial statements and their outcomes also. A new competitor coming to share the market with your client is also a major risk. And also ineffective employees that are not trained or they are not qualified is another internal risk. And poor financial management are also internal risks that could affect the preparation of financial statements and the overall strategy. So these risks need to be assessed when we are auditing the client. So risk evaluation looks at the impact and the likelihood. You are assessing the impact. So what's the probability that that risk will crystallize? So we're looking at risk from a proactive perspective. Before it happens, what is the likelihood that it will happen based on the current reality of the business? And what's the likelihood that it will crystallize? That means it will happen. So we prioritize high impact and high likelihood risk. What's the risk that we are going to lose a major client that provides 25 or 50% of our revenue? So we need to assess the risk of losing him to a competitor and make sure we manage those clients well and put safeguards or mitigants in place to make sure those clients are satisfied with our services or our products. So you are evaluating the risk based on the business's strategy and documents provided to you as an auditor. And the advantage is that in-depth knowledge keeps the auditor updated and he focuses on major problems bedeviling the company or the client. And it culminates in adding value. You add value by solving problems, profiling solutions. The value proposition is what you bring to the table as an auditor, not just sitting to provide an opinion, but also looking at the future of the company. You are futuristic in your approach also, and culminating maybe cost savings. You advise in areas of cost and help them to save costs based on your advice, and it differentiates the firm by this value you've added. So that's the advantage of really evaluating risks developing a company. And the disadvantages, the needs for experienced staff is actually expensive. Quality is expensive. What you get from a chartered accountant is different from what you get from a BSc accounting person. They're all accountants, but then the rigor of what the chartered accountant has gone through, you can't be compared it to just 4 years. Somebody went through BSc to learn. The chartered accountancy training platform is rigorous, is wide, is tasking. You have to know the stuff practically and based on practically. So the experienced staff based on qualification is expensive. It's expensive. To employ a chartered accountant now in Nigeria and a BSc, the gap is wide. So the closer involvement may affect independence. Some prefer system-based approach and may only suit large companies based on what we've been looking at basically. So the auditor needs to evaluate also at strategic and the high level. The strategic level is the highest level where management, the board, directors formulate these policies and the decision, and that's the top. And we look at the evaluation of risks from the broader business perspective. And this requires quality client information, open communication, and often industry specialization. So we look ahead and consider future development, not just the past performance. We look at what has happened in the past and what we could predict the future to be by the current course of actions we are going to be profiling. Very, very important. So like I spoke to internal and external risks, I was saying something about the business risk. So internal risk, like I said, could look at poor financial management, ineffective employees or weak leadership, and also inadequate system of control. So those would be internal risks that could bedevil a company, and you may need to address them holistically. And external risks may look at loss of a major customer, client, or contract, like I said, and the incoming or the entry of a new competitor. Also, regulatory changes, legal changes, fiscal and economic policy are also external risks we need to assess. Economic downturn, results, maybe supply chain issues for the company needs to be assessed. So the risk evaluation process, like I said, we look at the likelihood of those risks, the probability of them happening, and the impact on the company and its financial statements. So we focus on high probability, high likelihood, high impact risk, and it helps us prioritize audit efforts, and we design our response procedures appropriately based on this. So the advantages generally, like we spoke to, is to look at the client you are auditing. The advantages of the business risk approach is to encourage in-depth understanding of the client's business, and it keeps the auditors updated on key business issues that bedevils the client. We also focus on area of greatest risk, and it helps, like I said, add value by solving the client's problem, and it enhances or culminates in client relationship and can result in audit cost savings and better use of the client's resources. It also differentiates the audit firm by offering insightful risk analysis. Very important. So we're looking at the disadvantages now, which we are saying that the requirement for high experienced staff increases cost, but then there are some costs you may have to incur to grab the quality. So like I said, the quality of an ICAN chartered accountant is different from a BSc or an ordinary H holder. When you employ a chartered accountant, the product or the value you get is different from a BSc accountant. Is clear in the market. So the close, also the disadvantage or challenges the client may face is close auditor-client relationship could also impair independence. So auditors need to maintain their independence in providing this advice and provision of other services to the client. Also, some firms, audit firms, may still prefer the traditional based system approach, which may be outdated and may not holistically look at the business risk currently bedeviling the company. So it's important that firms align whatever approach they are using to the current reality of the business. And it may be less effective, whatever approach they are using, or less applicable to small or medium-sized companies. That's what the disadvantages speak to. So let's look at business risk and also financial statement risk. What's the difference? So business risk can lead to financial statement risk, which is material misstatement, because your business risk starts from your business strategy. And once the business strategy is wrong, it will culminate to or lead to wrong financial statements or material misstatements. And what does that mean? It means that business risks are broader. It affects the entity's overall performance and survival in the market, while financial statement risks are specific. So let's say business risks are general, financial statement risks are specific. So financial statement risk refers to risk of material misstatements in the financial statements. So what's the connection between business risk and financial statement risk? The connection is that business risk leads to financial statement risk. So for example, the loss of a key customer, like I said, maybe a customer that provides 25% to 50% of your yearly revenue, is a business risk, while overstated receivables or a going concern issue is a financial statement risk. So you can see the alignment. So the loss of a key business is business risk, then it could lead to overstatement of receivables or a going concern issue, which is a financial statement risk. So that's a brief example of business risk versus financial statement risk. Okay, so we just ran through Unit 2, the business risk approach. If we don't have any question, can we move to the next unit, the systems-based approach? Any questions, please? Okay, I believe we grasped that unit very comprehensively. All right, so let's look at the system-based approach. This approach focuses on internal controls and its adequacy. So as auditors, our role is to understand the internal controls based on ISA 315. And it's very essential we understand the controls of a business. And International Standards on Auditing 315 is a guide that helps us to understand these areas or this area very comprehensively. So the focus of the system-based approach is we need to evaluate and test the adequacy and the internal control system within the organization. So a functioning control system ensures that there's reliable financial reporting, operational efficiency, and compliance with laws and regulations external. So also compliance with policies, laid down procedures internal of the company is very important. So the auditor's responsibility based on International Standards on Auditing 315, you must obtain an understanding of the internal control system that is relevant to the financial reporting. So the understanding helps us to identify the types of potential misstatements. It also helps us consider factors affecting risks, and we design the nature, the timing, and extent of further audit procedures. This is very, very critical. So an effective system helps us with, like I said, reliability of reporting, efficient operations, compliance, and also testing of controls to see if they are effective to reduce substantive testing. So based on the components of ISA 315, the control environment, looking at risk assessment, information system, control activities, and monitoring. So these components are the COSO framework. The COSO framework gave us these as the 5 components of internal controls that will help us assess risk and to ensure that the controls are deemed effective and the auditor may place reliance on them, and it will also help us reduce substantive testing. Also, the controls must be well designed and properly implemented. The auditors will conduct a test of controls to evaluate and validate this. It's very important. So the key components of the internal control system, like I said, based on the control COSO framework, we'll be looking at it one by one. So let's look at the control environment. There are 5 elements: the control environment, risk assessment, information and communication, or information system, then control activities, and monitoring and evaluation. So let's look at them one by one. So what is the control environment? The control environment is the foundation for all components. It reflects management's attitude. Please take note of that. A question can come and they'll say, explain an effective internal control system based on the COSO framework. So please take note of that. The control environment looks at the management, top management's attitude, the board, the tone at the top, senior management, executive management, senior managers. It reflects their attitude, integrity, the ethical values imbibed by the company, and commitment to excellence and competence. So a strong control environment supports good governance and accountability. This is very important. So those are the components of a good control environment, and is key in the COSO framework of internal controls. So let's look at the second one, risk assessment. What is risk assessment based on the COSO framework? So the entity's risk assessment process look at the way management identifies, assesses, and responds to risk or risks that could prevent objectives from being achieved. So they include internal and external risks, like we've seen before. For example, technological changes, fraud risks. So the risk management component or function in a business based on the Institute of Internal Auditors model is the second line of defense. So big organizations have a unit that addresses risk, and it's called the risk unit. Some have even a chief risk officer that helps manage risk in very large organizations. So it speaks to the risk assessment process of a company and how they place particular emphasis on management of risk in identification, assessment, and response to risk that will prevent them from achieving their objective. So generally, risk management is proactive, and they try to identify risk and nip them in the bud before they crystallize. So this is very, very important for the second component. And the third one is information system or information and communication based on the framework. What does that mean? It involves how transactions are captured, processed, and reported in the financial statements. So I'll take that again. What does information system or information and communication speak to? How transactions are captured, processed, and reported in the financial statement. So as auditors, we examine the infrastructure. What are the infrastructure, the ERPs in place, software applications the company use? Who are the people involved? Are they qualified in the postings? What are the procedures and the controls that they use to post these transactions? And how do they manage data? So data management is very, very important. So we have frameworks like COBIT. COBIT is the control objectives for information and related technologies. It provides best practices for internal control. So you can take that down and do a further study on COBIT. It's called Control Objectives for Information and Related Technologies. This framework provides best practices for IT control and how to harness information system in a company. So that speaks to information system. Then let's look at control activities. Control activities. So what are those activities speaking to control or the controls an organization install? What are the activities, the day-to-day running of the company? They include procedures and processes, policies, systems. Some organization calls it SOPs, standard operating procedures, that help ensure management directives are carried out. So you have laid down rules and regulations in your policies and procedures. So for example, authorization controls. There must be approval before transactions are carried out. Very important. Approvals before actions are taken. Who approves transactions? These are control activities. So there must be approval before you do something, before you buy, before you give a discount. There has to be approvals from senior or a top person. We also look at physical controls, aside authorization controls, like the safeguarding of assets. Who safeguard assets? Is it the finance team? Verified by an internal audit function? Very important. So safeguarding of assets are also physical controls. And number 3, arithmetic checks. Reconciliations like bank reconciliations, monthly recalculations, recalibrations of values and figures. So arithmetic checks are also control activities. Then we have accounting controls like posting of journals, journal entries on the ERP, classification of assets. So those are accounting controls. We also have management controls like reviews, exceptional reports from auditors. So those reviews are management controls to put process owners in check. And also we have segregation of duties, very important. So no single individual can start a transaction and also approve it. So no single individual controls all aspects of a transaction. That would be fraudulent, it will lead to fraud. So you have segregation of duties. If you make, you cannot check. So if you make, maybe for example, a purchase order, another person should verify it and a different person should approve. So those are control activities that helps an organization stay in check, and those are good internal controls. So finally, let's look at monitoring. So monitoring activities, what are monitoring activities? Monitoring activities will speak to ongoing or periodic review of controls by management. It includes external audits. That's why you have external audits doing these periodic reviews. Also review of financial performance and supervisory checks. Also the external auditors come to do their financial statement reviews. And this helps to detect breakdowns or need to update the controls in the organization. So monitoring is very, very important. So an effective system of internal control based on ISA 315, the control environment, risk assessment, information and communication system, control activities, monitoring. We look at, in summary, that it's very important that management attitude towards the control environment is top-notch. Risk assessment and how management identifies risk, assess it and manage it is also key. And the information system on how transactions are captured and processed is understood, and the infrastructure, the software, the procedures, that data is captured and also disseminated within the system is top-notch also. The control objectives on IT framework is an example, and then the control activities, procedures to prevent or detect errors in authorization, physical, arithmetic, we spoke to accounting controls, management, segregation of duties, and also monitoring of these controls, which is management's review of control operations by internal audits, external audits, independent reviews are very, very important in the system-based approach. So the auditor's use of controls and also the testing of their efficiencies are good. So understand the controls as an auditor, confirm with your walkthrough test, ask management to walk you through so that you understand the design and its effectiveness. Also, we need to assess as auditors the effectiveness of the design of those controls and how they work and how it impacts the overall control environment. So as auditors, we evaluate high control risk by substantively testing them. And also low control risk, if they are well designed and they are working, we reduce our substantive testing. So it's very important that in our evaluation, we should test and be sure that these controls work. So the procedures you walk through the test involve walk-through testing, and the auditor traces a few transactions through the system from initiation to reporting. you confirm your understanding of it, and also verify that the design and the implementation are working. So it's not a test of control effectiveness, but you are validating how the control works practically. It's very, very important. So in assessing the effectiveness of this control, as an auditor, we need to evaluate the design. Is the control capable of preventing or detecting errors? So you have a difference between manual posting and electronic posting. Electronic and ERP capture of data is much more accurate, efficient, and faster than manual posting. And also you test the implementation. Is the control actually in use? Does it work? So this informs our assessment of control risks, which in turn impacts our audit strategy. Very, very important. So never rely on, as auditors, 100% that a control works 100%. They can never be 100% reliance. So never rely on 100%, or you believe the system works 100%. There must be one or two challenges somewhere, and it is called inherent risk or inherent limitations due to human error, management override, and collusion. So always assume this professionally and be skeptical when performing your assessment. So it's very important that a high control risk will increase our substantive testing from our assessment. That means controls are weak and they are unreliable. So we need to increase our substantive testing, while a low control risk will reduce substantive testing. That means the controls are strong and you can rely on them. So it's important to know that if controls are effective, auditors never rely 100% due to, like I said, the human limitation, inherent limitation of internal controls. There's always a residual or inherent risk, and it comes as a result of human error, collusion among employees, management overrides of controls, and these are factors that would make us not to rely on these systems, basically. So more efficient audits are for well-controlled systems are the benefits of system-based approaches. It encourages continuous improvement in the client system, also allows auditors to target risk that bedevils the entity and make us focus on those highest or greatest risks. It also aligns with modern governance and IT audit practices. So these are the benefits of system-based approaches in auditing. Okay, so we just looked at the system-based approach. I believe we have questions. Are there any questions for the system-based approach, so that we'll run through the last unit before we retire this chapter 6? Any questions on the system-based approach? Okay, I believe it's self-explanatory. All right, so let's look at the last unit, which is the statement of financial position approach. This approach speaks to an audit strategy that primarily involves substantive testing. It is typically adopted when control risk is assessed as very high. So the meaning is that the internal control environment or internal control system is weak or unreliable. So we employ the statement of financial position approach. Is used actually to address control risks when they are high, test details, and that's what substantive testing means. You test details, you go deeper, and you perform analytical procedures. So the focus is on testing balances and not transactions. You want to see the result. So from January to the end, what is the balance? And between that period of transactions, you are looking at the movements. Yes, please. I saw your hand, Julie. Please go ahead. Interject.
Yeah, you're saying that this substantive testing, it tests when the risk is very high. Use it to test for test details and procedures. Okay, but you said the focus is on testing balances and not transactions.
Yeah, so
but transactions are the ones that when you want to check for details. Is it the transactions the one the most important, or is it the balances? Is it meant for statement of financial position? or meant for income statement?
No. The statement
That's
of
the
financial
substantive
statement.
testing.
Yes, the substantive testing is mainly for balances, but you are not just looking at balances. You are looking at the trail that results into those balances. So you are looking at the details. So for example, the inventory balance at the end of the year, you may have to start testing from January to December.
Opening
Each
balance,
transaction, exactly, to the
transaction,
closing
everything.
balance.
But it is
Everything
saying here
substantive.
not transaction. It's saying testing balances, not transactions.
Yeah, so what we are saying now based on this focus is that you are not just testing transactions without any result. You are testing transactions to see that 1 + 1 + 2 + 3 is equals to 5 at the end of the year. So transactions is not the aim, but balances is the aim. Let it tally with transactions. So the transaction testing, you definitely test transaction, but it should result in accurate balance. That's what this statement means. So the focus is you are not just doing, because when you are testing transactions, some auditors apply what do they call this approach now? Sampling. You can sample, pick 1 or 2 transactions, 6, and sample. No, you can't do that here. You have to run through the trail, and it's painstaking because you want to not just test the transaction, but you want to see the balances culminate in the result of the transaction. So this statement sounds contradictory, but it's not. You are saying that you need to walk through them, analyze them, and be sure that they are correct.
Okay.
I hope you
Sorry,
a
sir.
bit correct. Yes.
Yes, sir.
Yes, please
Thank
go
you.
ahead. Okay. You're welcome. So these transactions are best suited for small companies with substantial assets and liabilities. So the logic is if the opening, like you said, and the closing balance sheets are correct, then post profit must be correct. And that's the logic. And that's what informs our judgment. So the substantive test we are emphasizing is that the auditor does not rely on the internal control. So the audit is driven by detailed substantive test of balances. And the analytical procedures must be done painstakingly to have evidence. The main aim is to gather sufficient appropriate evidence by directly testing account year-end balances from the beginning transactions to the year-end. This is very important. So the core focus is, unlike system-based approach that tracks transactions through controls, this SFP approach is about testing account balances directly, assessing financial statement assertions like the existence, completeness, valuation, rights, and obligations very, very critically. It means that the auditor focuses more on closing balances rather than the processes or controls that generate them. So you walk through them very, very practically. So for smaller entities, the definition is orchestrated ownership, simple transaction records. They have maybe few controls, and the control challenges may include lack of segregation of duties. One person is doing the same thing from beginning to end because it's a one-man business, and the reliance on the owner-manager involvement can be good but also risky. You also have lack of evidence, management overrides, and expertise challenges. So the auditors should focus on understanding and evaluating existing controls for small businesses that this approach or this SFP approach speaks to. So the logic behind this approach is that it's straightforward. So if the opening balances, like we said, are correct, the closing balances are verified to be accurate, then your profit or loss for the year may be likely to be correct if these tests have been carried through. So this balance sheet focused audit is particularly useful when transaction trails are incomplete or unreliable. So you have to perform a long, detailed walkthrough to ensure that they align. So it's best suited for, like we said, small entities where maybe you have low volume of transactions. And record keeping may not follow complex systems because of the number of staff and the size of the organization. Also, is suited for where internal controls may be weak or informal, where one person is doing the same beginning to end transaction, and entities with significant asset or liabilities such as, let's say, investment companies, property holding business, financial services firms may employ this approach practically. So The characteristic of these smaller firms include the concentration of ownership and management. That's maybe all these family-run businesses. You just do simple record keeping and business processes, and they have very few employees that result in limited segregation of duties, over reliance on, like I said, the owner manager who may be involved in all aspects of the business from beginning. He will be the maker and also the checker at the same time. So the control environment around small entities may be challenging. As a result of this lack of segregation of duties, one person will initiate, authorize, and record transactions. Risk of management override. The owner can override controls or influence the same records. Absence of sometimes documentation or formal documentation. Many decisions or transactions are undocumented or informally agreed. We just tell you, send me money. No approval, nothing. And they post the money and bank credits them, wherever it is. So all these control environment challenges, for example, dependence on the owner's integrity or knowledge, may vary in quantity or quality and objectivity. So our focus as auditors in this kind of environment is to understand the control environment if it's weak, and adopt substantive approach, like we said, and also adapt procedures to obtain reliable evidence. So for example, like direct confirmation, you could confirm from banks the bank balance, also confirm receivables with clients, and also perform physical verification of inventory, fixed asset to ensure their existence. Can perform cost accounts, not that you'll be doing auditing or auditing such a company from another location. It's good to physically verify this, perform recalculation of their depreciation assumptions and the percentages, and also interests on maybe loans collected. We also perform or reperform key financial calculations to ensure their accuracy. Just maintain skepticism as an auditor, especially regarding the owner-manager kind of input. So in summary, this treatment of financial position approach is very essential. We, as auditors, keep the aspect of the strategy type, which is substantive. Our focuses are on year-end balances, is best for small businesses or asset-heavy firms. And the reliance on control should be low, or you should even have none. The key advantage is you keep it simple and direct. And the key risk is that you may miss errors, fraud in transaction process as a result of the nature of the business. So that's generally what the statement of financial position approach is all about. So we've briefly summarized this chapter and the different types of audit strategies and factors that may impact which strategy we need to adopt, and the business risk approach and the ability to identify and assess business risks and the financial statements risk. Also, the system-based approach, we spoke to it and articulated the components of internal controls, control environment, risk assessment, control activities, monitoring, and we also speak to information and communication. So the summarized statement of a financial position approach, we also looked at very briefly. Okay, so I believe we don't have any question on the 4 units we just look at, and we have. Let's speak to that so that we can take our quiz and rush for break. Aisha is on the call. I hope she's not sleeping. Aisha, please confirm me. Oh, fantastic. That means you've been following through. Fantastic. All right. So with the absence of any questions, can we look at our quiz question? Can we? Or any question? Because this is Judgment D.
I'm sleeping.
You've been sleeping?
Sometimes sleep for that system approach. When I did not even, I slept throughout. But it's okay. By listening to the business approach very well.
Okay, you may have to go through the video again anyway. Well, this one you slept, now you may come and score in 100%. Don't try it in this this session.
I pray so.
Don't try it. All right, so let's look at quiz questions. I have A on the call and I have J on the call. So 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Okay, so let's look at number 1. If inherent risk and control risk are high, which of the following is most likely? A business risk approach to the audit, a substantive approach to the audit, a modified audit report, greater reliance on the work of the internal audit. Julie is already answering. Okay.
B.
B. I
B,
think A to answer. I know you said B. What did A pick?
A.
Okay, a business risk approach to the audit. Okay, both of them have differing opinion. Well, we'll see on judgment day. So A picked A, J picked B. Final answer. All right. The 5 components of internal control identified by ISA 315 are the control environment, risk assessment process, internal controls, monitoring of controls, and A, the information system, B, management responsibility, C, personnel, D, the organization structure. 5 components of an internal control system identified by ISA 315 are the control environment, the risk assessment process, internal controls and management of controls, and A, the information system, B, management responsibility, C, personnel, D, the organization structure. This one is tough. Everybody's quiet. 5 components of internal controls. What are your peak ACAs?
Thinking A, information system.
I think so too.
Are you thinking or you are choosing?
I'm choosing. I'm thinking and choosing.
Okay.
I think it's
final
A.
answer. Okay. Are you sure is A or you are choosing or you are thinking?
It's A.
Okay. A. All right. Final answer A. Which of the following statements are correct? Substantive testing is not required provided that internal controls are strong. Second statement, extensive substantive testing is required whenever internal controls are weak. So A, statement 1 only is correct. B, statement 2 only is correct. C, both statements are correct.
B.
D, neither statements are correct.
Wait.
J picked, she has picked B. I heard you say
I'm
B.
coming. No, I've not picked yet. So wait.
She doesn't want to do giveaway to the tutor. Anyway, let's see, Sha. A, what's your pick? Which of the following statements are correct? Number 1, substantive testing is not required provided that internal controls are strong. 2, extended substantive testing is required whenever internal controls are weak.
C.
A, statement 1
C.
only is correct. B, statement
C.
2 only is correct. C, both statements are correct. D, neither statement is correct. So you picked B or C. Which one is your final answer?
C. C, please. C, please.
J is picking C.
I'll go with. Oh God, I'm not sure.
I like this question.
I'll stick with A. Wait with A.
Okay. A is going with A. Statement 1 only is correct. And J is going with C. Both statements are correct. All right, we'll see on judgment day. What is the purpose of walkthrough test in an audit? A, they are used for substantial testing of transactions. B, they are used to select samples of items for substantive testing. C, they are used by the auditor to learn about the process and its controls. D, they are used by the auditor to check their understanding of a process and its controls. What is the purpose of walkthrough test in an audit?
Something like this.
What is the purpose of walkthrough test?
Why are all these questions I did 1 4 and I'm not sure of any?
What is the purpose of walkthrough test in an audit? They are used for substantive testing of transactions. They are used to select samples of items for substantive testing. They are used by the auditor to learn about the process and its controls. D, they are used by the auditor to check the understanding of a process and its controls.
Wow.
G said, wow. Definitely, you guys will do
They've had an audit before.
you did give away today. Nobody will do that. Go with 100% in this session.
If I even get one.
What is the purpose of walkthrough tests in an audit?
Just to save time. Then I'm going with B.
Okay, A is going with B. J, you may have to pick.
I'll go with C. Wait, oh.
J is going with C.
Wait, oh, no.
J is always ambitious. She wants to score 100%. It's good. But then remember to do giveaway.
I took D. D, please.
Okay. She has changed from C to D. Okay. Finally, which of the following is considered to be a key problem with auditing small entities? Directors may not work as hard as in large companies. Management may override internal controls that exist. The organization may have a poor cash flow forecasting system. The staff may be unhelpful. Which one of the following is considered to be a key problem with auditing small entities?
B.
C.
B.
Okay.
B.
Final answer. B final
Oh
answer.
yeah.
All right.
The main no,
Well,
B.
I wrote B.
Management may override. Yeah, I remember you saying something. Yeah, B.
Yeah, I had you B. Both of you said B. Okay, so judgment day. Let's go. Let's see our answers. Number 1, J got it B.
Oh wow.
A failed it A. B is if inherent and control risk are high, then a substantive approach is likely involving making detailed testing of transactions and balances. So a business risk approach is unlikely to be appropriate due to the scale of the risks and the need to reduce audit risk to an acceptable level. So let's go back to the question so that A can understand where she got it wrong. So if inherent risk and control risk are high, which of the following is most likely? The answer is B, you perform substantive approach to the audit. So the business risk approach is not likely because it's unlikely to be appropriate, looking at the scale of risk and the need to reduce audit risk to an acceptable level. So take note of that. And number 2, A, both of you got it. I say 315 identify the 5 causes. Information system is the 5th one. Very correct. Number 3, giveaway. Both of them did give away for me. Thank you.
Oh boy.
What was the answer?
A picked A, then C picked J picked
Even when
C.
internal controls are strong. And I wanted to pick that. I was looking at that.
No, wait, no. Let's go back to it. Let's go back.
Let's go back.
It's not required, provided that when internal controls are strong, sometimes testing is not required now.
No. Even if the internal controls are strong, it's required.
Well, it's not required. Well,
which one is
okay, it's still required, eh?
Yeah.
So the answer is 2. Exactly. So the answer is 2. Extended substantive test is required when internal controls are weak. So substantive testing is not required, and that's not the answer now. Did you see the answer? The answer is not A. And the answer is not C. So you say both statements are correct. So number 1 is not correct. The answer is B. You only do extensive substantive testing.
Maybe I'm not hearing, but soil testing is not required provided that internal controls are strong. Okay, it does not matter whether it's strong or not. Substantive testing is still required to check the balances.
Yes.
Okay, it's required to check whether strong or not.
Okay, whether it's strong or not. Oh my goodness. Okay, it's all right. It's okay. Thank you
for the giveaway. Both of you have given me giveaway. Good. So some substantive tests are needed even when internal controls are strong. So that's the answer. The answer is B.
Okay.
Okay, so let's go to number 4. Walkthrough tests are used by the auditor to check the understanding of a process and its controls.
Wow.
This helped them. So J got it. She said D. She sat down and thought it through and said D is the answer.
I can't remember you talking about walkthrough test too.
Me
Couldn't
too.
remember you talking about.
I was like, maybe when I dozed off. But I was
Yeah.
just
Me
using
too.
common sense, like, okay, walk through, you must have had the understanding.
Walkthrough tests are used by the
Exactly.
process.
So they are used by the auditor to check their understanding of a process and its control. So it helps them to assess the effectiveness of those controls and decide on the extent to which the auditor can rely on those controls and the amount of substantive testing that will be required. So walkthrough test, you can do it by interview. Somebody will say, walk me through your process.
Yeah.
So you are testing
Yeah.
to see if you understand it. Yes.
Yeah.
So if you see auditors, they could say, okay, walk me through your process. So that's a walkthrough test.
Okay, for them to understand your control.
To understand your control, exactly. All right, finally, you guys got it. B and B.
Hey!
Regardless of how well designed internal controls
20.
are, they are of limited. No, you have 40. You scored 2. You scored
But that's
2
still
over
low,
5.
over 100.
Over 100, well.
And I've been reading.
I would have
J,
gotten 100 though.
J did 80%. Ha, J, you are harsh. 4 over 5.
Ah.
Now
J
I
is harsh.
Can I say that?